All right. Good morning, everybody, and thanks for joining us today for the CRI's 2021 insurance update, where we're going to be talking about a lot of things going on that we see throughout the world of insurance. It's been a crazy year and a half that we've seen so far, and so we thought this would be a good time to really reconnect and go through some of the things we've seen, as well as some of the things that we maybe expect going forward. So thank you for joining us this morning. I'm joined this morning by our presenters are, first I've got Steve Williams, who's a partner out of our Montgomery, Alabama office. Steve, if you'd like to take a second and tell us a little bit about your experience and all the great things that you do for our firm and our clients.
Sure. Thanks, Scott. Scott's pretty kind when he says all the great things, but I've been with the firm a little over 20 years, and pretty much the entire time that I've been here, I've focused in the self-insurance realm. I've done some carriers, I've done some captive work, some risk retention groups, some health plans, kind of all over the board, retirement systems, kind of touched a lot of things over the years, but really the last 10 years, I've kind of specialized in the self-insurance world with group funds, health plans, captive insurance companies, and risk retention groups. And that's kind of my niche. That's where I stay, rarely get out of there.
And that's a good thing. That's a good thing, Steve. So thanks for that. Also with us today is Joe May out of our Jackson, Mississippi office. Joe, why don't you share a little bit about yourself also?
Sure. Thanks, Scott. Well, been in the business doing insurance work for about 28 years now. So quite a long time focusing on insurance. About the last little over 15 Carr and Ingram. So been here a while. Got a number of different credentials there behind my name that I know you guys like to pick on me about a lot, but I just want to point out that when I work with people like Scott and Steve, I mean, it's easy to get an inferiority complex. So that's my way of flexing on these guys a little bit.
Yeah, well, we're not done ribbing you for that because it's definitely alphabet soup there behind your name. But anyway, thanks for sharing that, and I'm glad to have you both on the call with me today. This is a little bit about me. I'm out of the Raleigh, North Carolina office. I've been with the firm about 8 years with a bit of a varied history, some internal audit experience, a lot of public accounting experience. We just can't quit this gig. Somehow it winds up being too good. In the insurance world, a lot of my work is focused on captives and a variety of types. Similar to Steve, some RRGs, some pure captives, on and on. I work with some carriers as well, and it's an area that the three of us really enjoy working in. It's an area where our firm has got some deep expertise, and it's things we like to do. This is the type of work we really enjoy. So that's just a little bit about us. And you can see I'm trying to keep up with Joe with the letters behind my name, but he's just too far ahead of me so far.
Hey, I've got my work cut out for me. I'm trailing you both.
No worries, Steve. Here's our agenda. We're just going to kind of complete the introductions as we've just done, and then talk a little bit about the industry overview, which is also going to include sort of a brief touch on about some things that we've all experienced, some of our shared experience over the last year and a half, and how that is really impacting things. We're going to try to focus that on insurance, although we also know that what happens in the world around us affects how insurance is done. We'll talk about what's happening in the carrier market to a certain degree. Joe's going to talk a little bit about that. I'm going to talk a little bit about what's happening in the captive world. Steve's probably going to jump in there because Steve's been at this game with captives a little longer than I have. Then Steve's going to take us into self-insurance funds, alternative risk management. And Joe's going to take us out with some discussion on what we're seeing on the regulatory examination side of things, as well as some compliance related matters. So With that, I think we're going to dive right into our industry overview. And really quick, before we start talking about things overall, here is a little bit of our breakdown of our insurance leadership structure. Phyllis Ingram, out of our Montgomery office, our leader, our guiding light, is in the office with Steve, and she's just fantastic to work for. Joe and Steve are our industry line leaders. Joe over carriers and regulatory matters, Steve over captives and alternative risk management. And then we've also got Bill Iupi and Robert Miller, who are our taxation leaders. Very strong, great guys. And then Dale, who is a subline leader of regulatory and compliance matters, a very niche practice that we have. And Dale is one of our most skilled professionals in that area. And then me at the bottom where I belong, and I handle a lot of the marketing related materials. So that's kind of us. Also, real quick, before I get into this, I forgot to do this at the start, but just a little housekeeping matter. If you have questions, feel free to put them in the chat or in the Q&A. We'll be tracking those throughout the presentation. If there are things that we think would really fit, we'll kind of bring those in as we're sort of talking through things. And then, we may have some that we save to the end, but we'll try to get to all your questions and comments as time allows. So yeah, 2020, 2021, it's amazing. We're still here and still upright, breathing and able to form complete sentences with everything that we've all been through. And a lot of that actually starts with our first bullet point that we have listed. I'm not actually going to say it out loud because it's still too fresh. But it's really turned our environment upside down, the working environment. It's had tremendous economic effects, and that's just sent a ripple through many different markets, including the insurance market. So just a couple of quick data points here that I thought you might find interesting is that between January 25th and January 29th of this year, so just right on the back of 2020, the World Economic Forum estimated that about 93 of the global workforce was operating under some form of work restrictions, which is just bonkers. Is the only word I have. It's a very technical term. And based on what we saw from those various restrictions and things like that, they also estimate that about 8.8% of available working hours in 2020 were lost as a result of those. So, what does that really mean? That's the equivalent of about 225 million full-time positions that productivity lost in 2020. And when I really saw that, it just sort of blew me away at first. And then, we sort of start thinking about, well, what does that mean? How does that impact things? Well, it's really thrown what was already sort of an economic period of turbulence that we were expecting, and that really the insurance markets were anticipating even before COVID-19 reached our shores or reached anyone's shores. If we think back to that, almost what we would refer to as the before times, they were already pricing a lot of risk, but this really just sort of took our thoughts on risk and put them in the spin cycle. So what are some of the effects of this? The U.S. central bank rate, the lending rate for banks is essentially zero. I think it's technically 0.25%, but that's essentially cash is almost free. And in addition to that, worldwide, about 60% of the global economy for those central banks, lending rates are below 1%, which has a dramatic effect on investments, has a dramatic effect on pensions, has an effect on a lot of things. And in 1/5 of the global economy, interest rates are effectively below 0%, which is incredible. In addition to that, we've seen a lot of of governments throughout the world taking on some tremendous fiscal deficits to try to fight this, right? I mean, it's a massive, massive global affair. I want to say for the US in 2020, the deficit was about 15.8% of GDP. And for 2021, we're projecting that to come in right around 15%. So a little less, but still not great. Additionally, when we think about what's the effect on the workforce, well, there's a lot of stuff that we came in the office to do that a lot of people are wondering, do I need to go back in the office to do it? And in some cases, the answer is yes. In other cases, maybe not. Again, the World Economic Forum estimates that in developed economies, about 20 to 25% of the workforce, those jobs could effectively be 100% telework, or what we consider to be working from home, which again has dramatic effects on what we see throughout the economy, which has effects on how we perceive risk. Additionally, we've seen some significant increases in e-commerce, which causes some disruption again in the workforce, as well as through the supply chain. And we anticipate that ultimately this is going to accelerate the adoption of AI, machine learning, and its involvement in the global economy. We'll talk briefly about that here shortly as it relates to insurance. But some things that we've seen in a lot of things. Again, 2020 was just a crazy year to even think about, and it feels like we're still in the second half of 2020. Even though the calendar is flipped over a page. So, this has required our regulators to really be on top of things. They've been very active in COVID response. There's a lot of materials out there that they made available, a lot of things that we've had to create on the fly, essentially. So a lot of activity there. There's been a lot of activity in the business interruption market. I was looking at the data yesterday, and I think at the federal court level, of the cases that were submitted, I think there were about 339 cases that have made it into the federal court system. Of those, 228 were fully dismissed with prejudice. 30 were fully dismissed without prejudice. And then I think of those, about 22, those motions to dismiss were denied. So of 339 cases, 6% will actually proceed. So that'll be interesting to see. It'll be interesting to see where things go from there. Additionally, we're expecting to see changes in the tax environment. We're seeing a ton of fiscal activity. And we have an administration that thinks the government has a role to play in restoring global economic stability. However, that comes with a price, the details of which we really don't know. At this point, it's all speculation, but a lot more to come there. So, somehow we made it, somehow we survived, but there's more fun to have for sure. And really quickly, I just wanted to talk a little bit about some things we see happening as it relates to the rise of technology throughout the global economy, but certainly as it relates to insurance. One of the things we've been seeing is this rise in insurtech. So as we all know, traditionally, the way insurance would work is that folks who are seeking policies would apply, and based on some actuarial data, actuarial tables, they're going to get lumped in certain groups, and they're going to try to adjust those to match them up so that they can effectively make money on those policies. Pretty standard things like that. That's just how it's been done for years and years and years. And what we're seeing happen again through the use of machine learning, through the use of AI, and I guess deep learning, which is related to machine learning. Quite frankly, I'm not smart enough to know the scientific differences, but they're all kind of interrelated there. What is being used now is modeling. and at a deeper level, and pulling from data that may or may not have been available or readily available in the past. And this is we expect is going to have some tremendous effects on pricing going forward. And we also think that this may enable the insurance markets to be able to price things at more of a micro level. It may change, what exactly it means to have diversified risk and things of that nature. And so there's a lot more story to tell there. I think Joe may have some comments on that a little bit later in the presentation as well. And I would sure hate to steal any thunder from him, because as I said earlier, he's way smarter than me. So given all that, I think I'm going to let Joe take it from here and start talking about carriers.
Thanks, Scott, for putting me up on that very high pedestal to fall off of here momentarily. But we'll go ahead and talk about carrier insurance a little bit. And what we're talking about when we say carrier insurance, we're talking about the actual companies that bear the risk. So within that broad category, there's several sectors or types of companies, and we'll go through a few of those. Property and casualty, probably one of the certainly more common areas, often referred to as the yellow book filers of old. If you guys remember, years ago, filing rooms were physical paper, and that was a way to walk in and identify what kind of company you were looking for. So you looked at yellow books, that was a property and casualty. And within that broad category, you got everything from auto, home, business interruption, workers' comp. So a really broad umbrella when we say that. Next, life insurance companies or blue book filers. Under that umbrella is just a ton of things we could cover from term life to whole life to annuities. So another broad umbrella. Health companies, we're not going to talk a lot about today just because of time. I think that was the orange blank at one point. Title companies, we do some of that work as well. I think that's kind of a peach color. And then even fraternals, we work with those. So we could really spend probably the better part of the mornings in any one of those categories, but we really want to focus more on the P&C and life companies today and just really hit some highlights on what's been going on in those sectors. And specifically, how we've been impacted by COVID in 2020 and what we see coming down the pike in 2021 so far, and trying to look through that looking glass into the future and what we think might be happening. And Scott mentioned this earlier, and he was spot on. The insurance industry was impacted by COVID, much like any other industry. So we had a lot of things and a lot of commonalities there for sure. One of the things we saw, obviously, was an overnight shift to remote work and virtual customer engagement that exposed a lot of weaknesses in our digital capabilities. So all of that, while dealing with cybersecurity concerns, really significantly increased cybersecurity concerns driven by that. So really just had an increased reliance on connectivity, remote access, all of that creating new risk for both the insurers and the policyholders. It really presented, the pandemic did, just a need to accelerate digitization and increase virtual operations. So we've been seeing that across the industry. And before we get into the P&C slide next, I cover a few more things here that impacts both P&C and life companies. In fact, really all of them. Is a couple of things. And there's been some studies in the insurance industry specifically, but it's pretty consistent with what we're seeing in other industries. Hiring and keeping talent in the workforce has been something that the industry struggled with. The insurance industry already has a median age that's higher than most of the rest of the financial sector. So replacing that talent is going to be something that's going to become a serious issue. Now, companies that are able to seize and jump on that opportunity to rethink, the purpose of office work, to reskill teams and meet current needs will certainly have an advantage, market advantage in the future. Two points worth talking a little bit more about. It's office work. I mentioned that. Currently there's a pretty big gap between employer and employee expectations on returning to the office in the insurance industry. And generally speaking, what we're seeing are the employers are ready to return to the office, and the employees aren't fully on board yet. So I think it's important that insurance companies understand that gap, and that gap exists, and for those that seek to close that gap, and acknowledge it and close the gap to the extent possible, that's going to give them certainly an advantage. I mentioned reskill. With all the technology changes that's happening, we're seeing a lot of changes in processes, obviously increased use of technology. Those things can quickly create a skill gap for employees. So while all of the core skills and industry specific knowledge is still needed, and now we have to know things that with maybe data science and digitization or other technology things that's creating some challenges in our space. Another thing we've seen overall is just rising customer expectations. And, you know, this is something that I think is driven by people being a little more digitally savvy. And it really poses a challenge for carriers, as we've seen a lot of intermediaries assuming more risk, finding ways to strengthen their relationships with customers. And for insurance companies and carriers that ignore those expectations, there's really a risk that, you know, their services will become and products will become more of a commodity. And that's a very costly thing to the bottom line. So with that, let's flip slides, Scott, and run over to the P&C slide. We'll drive into that just a little bit. Pandemic losses, you know, hurt certain areas of the P&C sector bottom line more than others. The first half of 2020, we saw writing like things, you know, cancellation and event cancellation insurance, workers' compensation, those lines hit very hard. Overall, we saw profitability indicators drop during the pandemic, as we saw lines with increased losses and concurrent drops in premium income. The aftermath of the pandemic is expected to continue hitting some of those lines harder than others. Mentioned workers' compensation, insurance sales, for example, in workers' comp were undermined by massive job losses. So we'll have to see how that rebounds with the economy. In addition, we've seen small business premiums. You know, that sector was hammered by shutdowns and bankruptcies. So as that all comes back, we'll have to wait and see how that recovers as the economy gets back on footing as well. There were a few bright spots as far as the numbers go for P&C carriers, and one of those things being auto insurance losses were down for obvious reasons. You know, of course, people weren't traveling as much. We're not even driving to work. So we had losses drop significantly in that space. During that same time, though, we had carriers offer rebates, rate cuts, that kind of thing to reflect that less driving. So that ate into our profit side on the P&C sector as well. We're seeing things like customer needs change as a result of the pandemic. The industry is seeing increased customer interest in things like usage-based car insurance, short-term income replacement for job loss, and short-term mortgage payment coverage in case of job loss. Seeing short-term business expense coverage in case of forced closures, and even protection against liability incurred from employees or consumers when catching a disease in their place of business. So all those things are really driven by what we're seeing again across industry sectors, and that's just changing customer behavior. You know, people staying home more, more online shopping. We've seen a lot of trading down, people buying cheaper, focus on well-being, and more buying local. So circling back, I mean, it's just important for every company to take a deep look at their customer needs and expectations, especially as they're changing as quickly as they are, and looking at the current team and processes for delivering those services and the products, and just meet those needs. Use this opportunity of radical change really as an opportunity to retool and better service those customers. Let's flip on over to the life slide and talk a little bit about what we're seeing in that market. During 2020, we saw life insurance premiums decline approximately 6% globally. So through the end of 2020, we had a slightly higher decrease in advanced economies. It's expected that 2021 will continue to see a recovery overall, with emerging markets likely leading the way on the recovery. We saw, as you would expect, a drop in annuity sales, took a big hit during 2020. And reading a lot of the reports lately, we're seeing a lot of experts that think we'll see an increase in consumer demand for life insurance products during 2021 and beyond. based on, their experience with the pandemic. So hopefully we'll continue to see a strong recovery and good growth rates in that space. However, growth and profitability in both annuities and many life products will likely continue to be impacted during 2021 and potentially well beyond by persistently low interest rates. And, that's something that we've been dealing with prior to the pandemic. But the pandemic threw all of these other concerns right on top of it. We're hopefully coming out of the pandemic, and we're seeing that same struggle with the interest rates. So that's something that's just going to have to stay on the radar of life insurance companies, and really staying on the investment side of the balance sheet for life companies. Life insurance companies hold a lot of assets, one of those being mortgage loans. And as you know, the pandemic impacted mortgage payment requirements, consumers' ability to pay, a lot of different things there. So looking at the assets, if you're a life insurance company and doing a full scale assessment of that is certainly key. And much like a lot of the other industries, we're seeing life insurance do a greater share of their business with less in-person interaction. And that's a trend I think we'll continue to see. In fact, less than a third of people buying life insurance policies since the pandemic have done so solely in person. And that compares to about 44% before. And a lot of the people that we're seeing come over from doing it solely in person are using some kind of hybrid model. So we're seeing some contact, but not as much, and basically a transition over to that virtual side. We're seeing life insurance consumers expect faster turnarounds, and that's leading a drive for more automation and accelerated underwriting by insurers. We're seeing life insurance rates stabilize now. Early in the pandemic, certainly we saw rates shoot up. That seems to be now moving more like they did prior to the pandemic. So that's a good thing to see kind of stabilizing out. And I think, Scott, you got to cover some of the captive slides next, I believe.
I do. Thanks, Joe. And I'll pick it up from here. Thanks for that conversation on what we're seeing in the carrier markets. And I'm going to talk for a few minutes about captive insurance as well. So, with all these things we've been talking about, all the changes, all the ripple effects, this is what I think the majority of our risk managers on the client side are looking at when they're hitting renewal time and things like that. Even before COVID, we were seeing insurance renewals at some pretty significant rates, particularly in areas involving transportation, or where we were seeing, even as basic as physical damage risks in areas that were anticipated to be at a higher risk, either through flooding or hurricanes or whatever. So, and certainly 2021 has not left us wanting in that regard, when we saw a giant ice storm in Texas of all places. And right now we're seeing the upper Midwest hit record high temperatures and things that they're just not used to dealing with. So this has all put a lot of pressure on a lot of clients out there, on a lot of companies out there. So they're looking for alternatives, and one of the alternatives that they're looking at for risk management purposes is captive insurance. Just a really brief introduction here for those who may not know. Captives or captive insurance, these are small insurance companies. And when we say small, we don't mean in terms of, say, asset size or things like that, but basically these are insurance companies that are set up to serve a very specific purpose or a very specific group of people. So unlike a carrier that we normally think of, these are set up perhaps to serve one particular company or the employees of that company, examples like that. And these are very effective risk management vehicles for our owners. They can be employed to mitigate risks or manage the levers of insurance coverages in a number of different ways, and we've seen that be very effective. It's important to note that these are regulated entities. These are licensed insurance companies, so they get the same view from the state departments of insurance that other insurance companies do, although they may get some slightly different treatment. And these are generally managed by a third-party captive manager, and we work with a number of those. We love our captive manager friends. I think I saw some of them in the participants list as well. So because of all those things, there's a ton of interest in captives. People are good captive candidates are seeking ways to basically to maintain their coverages as they can, but to find a way to do it in a more economical way. Or they're looking for ways to provide better coverages. There's a number of different reasons, but certainly the renewals that we've seen in late 2019 as well as throughout 2020 have really just turned the interest in captives to it's hit a fever pitch. And I expect that to continue. We're not seeing rates go any other direction but up. So interest is naturally going to follow for captives. We're seeing a lot of activity in terms of where these captives are domiciled, and by domicile we mean what jurisdiction are they licensed and operating in. So historically, these have largely been, say, in the U.S., Vermont, or offshore. However, in the last 10 to 15 years, we've seen a lot of states, particularly some of the states in our firm's footprint, try to make themselves attractive for captives. They see this as a way to generate some economic benefit. I think they're looking at this as a way to also generate some revenue activity without having to mess around with the T word that nobody likes to talk about. We're also seeing them try to maintain some sort of home field advantage of sorts when it comes to where these are domiciled or incorporated. So we're seeing a lot of changes there. We're seeing a lot of onshoring of captives. We're seeing a lot of captives moving to different domiciles within the United States. There's a lot of activity there. And even, when folks are creating new captive formations, we're seeing those states try to maintain them within their borders. So a lot of things that we're seeing going on there. And in fact, Steve, our colleague Stephen Larady out of our Nashville office, and I will be doing a webinar with Captive Review later this month. Well, not later this month because it's still June, but in July, related to that very topic, where we're going to spend about an hour talking about what we see going on with the various insurance domiciles. The 831 gold rush appears to have slowed, although we do see a lot of those formations still. We do see that a lot in some new formations. And really what we've heard from a lot of captive managers we work with is that 831B may not necessarily be what we want to be long-term. It may not be our vision. It may not be our goal. But where we can, we're going to try to take what the tax code will give us. But we also see a lot of folks trying to make sure that the fact pattern they've got behind their captive is something that will stand up to those folks we see in the last bullet point, the IRS, who have some well-publicized activity in this market. They've been very, very active of late. We'll talk about a little bit of that on the next slide. But they have really taken a heightened interest. They've created a captives, I think it's a division, and that is to basically take a look at these 831B captives, which are small captives that their premiums are below, I believe it's 2.3 million, or I think it's 2,350,000. Steve, correct me if I've got my numbers slightly off there, but I think it's 2 million 350,000 this year since it's adjusted for inflation.
Yeah, it's adjusted up annually, and
Right.
those that fall up underneath there.
Right. So for the purposes of looking at those, because those specific captives do not pay tax on their underwriting income being their premiums minus their losses and adjusted for some changes in the loss reserves or discounted loss reserves, as well as changes in unearned premium. So all that insurance activity doesn't get taxed. They only get taxed on investment income or other income that they may generate. So the IRS sees that as an opportunity to shelter tax revenue. So it's kind of like that song where it goes, why is everybody always picking on me? Well, that's what we're seeing the IRS do with captives. And we've seen that happening for essentially the last 5 years straight. So this is kind of our list of major tax court case wins on the IRS. And they are very much, if they could rent a billboard and put it up there, I think they would. And all they would put in big capital letters are these 4 case names. Avrahami in 2017 versus commission. All of these are versus commissioner. Reserve Mechanical in 2018. Syzygy in 2019. They took a break in 2020 because, well, we had to. And then Kaler Land and Development in 2021. So, and with each of these, they've attacked certain different elements in many ways. So with Avrahami, they attacked, is this really insurance? And is the captive actually at risk for the activity they say they're doing? And the tax court found that they did not believe that they were. With Reserve Mechanical, they challenged whether it was doing insurance, but they also challenged its participation in a risk pool. And ultimately, the tax court believed that their participation in the risk pool was not sufficient to count as insurance. And so that one went down in the books as well. With Syzygy and Kaler Land Development, they've attacked a few more specific matters. We're also seeing the IRS taking a look at the use of quota sharing arrangements. So we see this a lot in cell captives or segregated portfolio captives, where these are created so that there's one company that's doing all the activity, but then it has agreements with the additional cells within that captive to basically sort of divide up the risk, split it out, and do it that way. We've seen the IRS begin to ask a lot of questions about those. Primarily, their first question is, what is the business purpose of this transaction? What is the business purpose of having a quota share agreement? And so we've also seen, as a result, and we've been advising some of our captive managers on making sure that the business case is there to support those agreements, those quota share arrangements. All they do is win, if you believe what they say through the tax courts. And as a result, the IRS has put out I believe two now, right, Steve? They're probably planning a third of what I've been calling love letters to our captive owners, basically saying if they want to settle up now, then they won't get chased. But we also look very carefully at our clients' fact patterns, what they look like, basically so that we can advise them as best as possible. So, either way, it creates unrest, and it creates a lot of questions. And in the 831B market, we've seen a lot of folks take the settlement and just say that this is not what they want to do. They don't want to feel like they're doing what they consider putting themselves in harm's way. But what we also don't know is we don't know all the doors the IRS has knocked on where they've said, you know what, maybe we won't stop here. We're going to keep moving. And part of that comes down to making sure that the fact patterns we see with these captives are strong, that they're effective, and that they would withhold the scrutiny of an examination. So an important point to make there. Additionally, and this will be the last point I make because I'm trying to keep this a bit high level when it comes to what's going on with captives, We have the CIC services versus commissioner case. And so CIC services, a captive manager was challenging an IRS notice that is infamous in the captive world, notice 2016-66, right, Steve? Isn't that it?
1666.
Yeah, just a lot of sixes in that in that notice. It kind of messes me up a little bit, but essentially what that created was a requirement for captives to provide a tremendous amount of background data on the captive owners and the captive transactions to the IRS. So the IRS was collecting a ton of information. And really what that required of the captive owners is it created a lot of cost. There's a lot of work that's involved in doing that. It is a compliance activity, and that compliance activity is not cheap. So CIC Services was challenging the notice on the grounds that this created a de facto tax of sorts. In this initial suit, the commissioner, or the IRS, I should say, filed motions to dismiss the case on the grounds that basically CIC didn't have a case to make, that the IRS's jurisdiction was sort of preserved. This went all the way through the courts, went through all the tax courts, through the appellate courts, all the way up to the Supreme Court of the United States, where they heard arguments in October and ruled just a few weeks ago that they believe CIC Services has grounds to make a case. So this is really the first big challenge to the IRS's position that we've seen through the court system. It's not a win, I wouldn't say, because it's not settled yet. Really, all this means is that CIC Services goes back to ground zero and files the actual case that they wanted to file. But it could signal a bit of changing winds, changing tides when it comes to the court's position on captive insurance. So a lot more story to tell there. What were you going to say, Steve?
It's a bit of a pothole in the road the IRS was headed down after they had made a couple of wins and were kind of excited. Then this case came down and kind of stalled their motivation. But the thing you mentioned is that these captives are a great risk management tool when they're set up properly. And the thing with Abercrombie, it just always stands out to me when I see this, is that this captive, it was set up and the guy was basically insuring jewelry stores and paying exorbitant terrorism premiums for the jewelry stores. And then he was taking the money and making loans out to other companies. So, it's almost like he took a softball and set it on the tee and handed the IRS, those giant bats that we used to play with when we were kids, and said, hey, here it is, come look at me. And so the fact pattern that you mentioned, that's the key thing when we're dealing with captives and talking about captives is there a business purpose? What are we set up to cover? Is it valid risk? Are we paying claims? And that was another thing with that case, is that they had never paid a claim until the IRS sent them a notice, and then they paid a claim. So, that they have some wins, but where they're getting their wins are sometimes examples like that. And like you said, Scott, I'd love to know how many times they knock on the door of a manager and start going in and they say, you know what, we're not going to win this. Let's back out and move elsewhere.
Absolutely. Thanks for those comments too, Steve. And I think it's your turn to talk again. So I'm going to get quiet and let you start talking about self-insurance funds and what we're seeing in the alternative risk management space.
All right. Well, you can skip over to a couple slides there. If nobody felt like this last year, you were in your own world. I mean, I don't know how many different things kept changing. It seemed like every week we were getting different guidance. Do you come into work? Do you work from home? When you come into work, how far apart do we stay? What kind of sanitizer do we use? Can we even find hand sanitizer this month? I don't know how other locations were, but where I live, we actually had a brewing company who began manufacturing hand sanitizer and just giving it out to the public about April or May, just free hand sanitizer to the people to kind of do things. So, last year with the self-insurers and the pandemic was definitely an experience. I know we've been talking about that the whole presentation, but it's kind of, there was just uncertainty, and there's still a lot of that uncertainty. So, you know, Farley was one of my favorite comedic actors, and that expression there pretty much nails the way I felt the whole year. So what I got asked to talk about were self-insurance funds and alternative risk management, and just, you know, kind of what that is and how it got affected by the pandemic, and kind of what we've seen and what we're seeing. And, you know, if you're not familiar, typically the self-insured groups are going to be your workers' comp. Occasionally we see some property and casualty that gets self-insured and group funds, but predominantly it's work comp. And then you have a lot of health plans. And those, depending on, you know, the state or the area that you're in, they're regulated much like carriers. You know, most states would be statutory accounting, same type filing requirements. Occasionally you get some Department of Labor. For your health plans, you know, you got ERISA, you got, you know, the benefit plan regulators, Department of Labor again. So heavily regulated groups. The structures on those tend to vary. We do a lot with what we call group funds. It's basically, there'll be a sponsoring association like an automobile dealers association or a nursing home association or a forestry association. And those associations band together to provide work comp to the members of that association in order to kind of do so at a more competitive price and return any profits to those members. But also you'll see, you know, General Motors, for instance, they self-insured their workers' comp for a long time. Ford, a lot of large companies, hospitals will self-insure their own workers' comp. So a lot of different structures. But as we went through last year, there were a lot of questions with work comp. You know, was COVID-19 going to be a work comp claim? Is it an occupational hazard? And if you're not familiar, the key with workers' comp insurance and coverage is that the key words are occupational injury or disease. And, you know, that sounds pretty simple. If I'm a forester and I'm cutting a skidder and I knock a tree down over on top of me, yeah, that's an occupational hazard. That's a work comp injury. If I'm hooking up a trailer and loading up a truck and, you know, I close my hand up in there, yeah, that's a work comp injury. But historically, communicable diseases like flu, colds, you know, the swine flu, bird flu, when they came through, those were never considered for work comp claims or coverage. And the pandemic has been the first time that they were ever considered. And beginning in March of April of 2020, we had OSHA coming out, and at first they called it a communicable disease, which meant that it was an occupational hazard and communicable disease, which kind of meant it might be covered. And then they came back and said no. So they went back and forth. We saw states across the nation trying to figure out what to do, because you had your first responders, you know, your EMTs, your nurses, your doctors in the hospitals, your firefighters, your policemen. These people that, you know, they were in their office at work every day, exposed to other people. They had to be to do their jobs. So you had about 24 states across the nation that enacted some type of order or regulation to kind of provide coverage specifically to those people for workers' comp claims or coverage. If you're a health provider or a health plan, self-insured health plan, it's covered. You know, it's like any other disease that somebody contracts. It falls in as a claim. But it was kind of interesting with the health plans that I worked with. What we saw is we did see quite a few COVID claims and exposures occur, but we also saw the other normal costs that they would typically incur coming down. So the claims kind of balanced out over the year for the health plans. Just because people weren't getting out. You know, if you weren't getting out, you weren't getting flu, you weren't getting, you know, as many viruses, you weren't getting as many other things. So you also weren't going to see doctors in their office and having higher copays and things of that nature. So the claims kind of balanced out over the year on the health side from the plans that we worked with and saw. But from the work comp perspective, it's what do we do? And like I said, 24 states have had some legislation on the books. You know, in our footprint, you know, Arkansas, Florida, Kentucky, Louisiana, Mississippi, New Mexico, North Carolina, Tennessee, Texas, all these states have had something proposed, but in almost every single state, it has failed or been voted down, which, Alabama, where I'm based, it hasn't even been proposed because of the way work comp works in the state of Alabama. Cases can go to actual court trial rather than an administrative body. So executive orders to make work comp cover something like a COVID-19 or a swine flu just aren't very effective. So a lot of confusion there and over what it is and what's covered. But in these states that have kind of begun to deal with it, we look to see some things get finalized in the next year as to whether or not they're going to actually cover it. Because like I said, most of it's still in legislation. But what we really saw is a lot of questions, questions about how are my premiums going to be affected? If I'm in self-insurer, the National Council on Compensation of Insurance, the NCCI, they provide your rates for your premiums. So if I'm the self-insurer, my rates, my premiums that I'm charging my members are based on the classification of their employers. And what we saw is the NCCI, and I'm going to go through this very high level because we're kind of running low on time and we'll leave some time for questions. But the NCCI issued several new rulings that addressed COVID-19 during 2020 and 2021. One of the rulings specifically related to, for instance, if I drive an 18-wheeler every day, but right now I'm getting paid to sit at home for 4 or 5 months because my company's shut down, or I drive a skidder for a forestry company and I'm getting paid to sit at home. The NCCI looked at that and said, well, this is typically a high risk classification with a high rate. And what they did is they went out and created a new class code to provide for when those high risk individuals are sitting at home to move them to that class code so that it reduces the premiums. Another thing the NCCI did was they provided some new class codes for claims. One of the things that we're hearing is they created a class code specifically for COVID-19, for the hospitals, for the police departments, the fire stations, the EMTs, people that it's a covered communicable disease. The NCCI has created a code for that. But they've also created a code for reactions to the vaccine, which I was really shocked when I saw that. But they already have implemented a code. If I get my second round or whatever, and I have blood clots or some type of these minute reactions, there's a code for that. That's the first that I had ever really seen that be created. So a lot kind of going on in that world. It's really, everything is still up for debate and a lot of questions, and nobody really wants to come out and give a hardline answer or finalize anything. But we have seen some answers there as far as premiums, and we're running short again on time. But in our resources there, we listed a couple websites, and if you were to go to the NCCI website, SIA, Self-Insurance Institute of America, is a great resource for self-insured companies and groups. But we've noticed, check your State Department of Insurance, State Department of Labor, NAIC. These organizations have a lot of great resources that can help answer questions related to the pandemic and insurance. Kind of other areas that we've seen in self-insurance, and again, I'm going to move through these really quick, but predictive modeling has been used for years. The automotive insurance is, they're excellent at it. That's why my 16-year-old son's insurance is, 3 times as much as mine is. They're great at it. They know where their risk is going to be. Well, within the self-insured market with work comp funds, it's kind of been the talk at SIA for probably the last 10 years, but we're really starting to see some self-insured group funds really start to use predictive modeling to the point where they can tell you if somebody's been on the job 3 months, what type of injury they're likely to have, where it's likely to occur. Somebody's been on the job a year, 5 years, they can really pin down. And what that does is it enables them to really focus training with those individuals to prevent those losses and cut their loss ratios and claims expenses. Regulatory, Joe touched on briefly, competition. there's always competition in these markets, but I'll kind of just leave it there and we'll pass it back to Joe.
All right. Thanks for that, Steve. And Joe, if you kind of want to take us out with some comments on what we're seeing from our regulators and the compliance related activity.
Sure, Scott. Thanks so much. Thanks, Steve. I'll tell you, I can be really short on this slide because what we've done throughout the presentation, we've really integrated a lot of the comments about what regulators are doing with the different types of insurance. And so we've covered a lot of this already. So I'm going to be pretty high level here. One of the things that insurers are likely to see regulators paying special attention to is going to insurance departments is going to be heightened, increased study of the market conduct activities, solvency concerns, that sort of thing. Early on in the pandemic, we saw state insurance departments and the National Association of Insurance Commissioners, or NAIC, they were really active on the policy side of protecting policyholders. And that, examples, policyholders that might not be able to pay premiums timely. And now we're seeing a shift to different kind of market conduct interest and solvency concerns. But back as early as June 2020, we saw the NAIC issue reports on insurers' exposure to bank loans, to loan obligations, to mortgage loans, which I talked about that a little earlier too. Today, the NAIC still maintains its coronavirus resource center. That includes a summary of state bulletins and alerts, NAIC resources, other resources, including insurance policy coverage information. And Steve had on one of his slides just a minute ago, the NAIC website. That's a really good website to go to for overall information. Some cumulative information from the different state DOIs are on there. That's NAIC.org. And he also mentioned this, which I think is really important, whether you're a consumer or an insurer. The other website from a regulatory perspective that I would go to is whatever state you're in, your home state insurance department website. And then that's probably going to have some links as well to NAIC, but that's a great source. Those two sites, or potentially more, is a great source of information for you. Some other things, just from a regulatory concern, a little more legal than just pure regulatory. We're seeing claims on business interruption policies. I think, Scott, you mentioned that a little bit earlier too. We think, that'll continue to be a concern as court challenges, work their way through with COVID-19 as that all plays out. Likely to see workers' comp disputes rise as we see workers returning to the workforce. So a lot of things going on there. We could talk about this probably for a good hour in itself, but we have about 2 minutes left. So I'm going to leave some room for questions here right at the end, and then and again, just recapping more information on this, be sure and check out those slides with the websites on it.
Thanks, Joe, and we appreciate that. As we said earlier, Joe actually works with a lot of departments of insurance as our firm performs some examinations for, I want to say 10 or 11 departments of insurance, right, Joe?
That's right.
So if there are any other questions, we've still got a couple of minutes. I don't see any in the Q&A box or in the chat at the moment. But if you have questions later following this presentation, or if there's a way that we might be able to help you, our final slide, well, one of our final slides has got our contact information. You can reach any or all of us. As well as some of those great folks that we listed earlier in the presentation. Otherwise, we appreciate your time. If you'd like to continue the conversation, we're on the major social media outlets. You can find us on each of these or on our website, cricpa.com. And beyond that, we appreciate your time. We appreciate you sticking with us and taking an hour of your day to spend with us. And I think we've still got an hour left, so I'll hold it open for a minute in case there's one more comment or anything else that anyone would like to make. Otherwise, thank you again. Hope you have a great day.